35 minutes of presentation and followed by questions. But I do encourage you actually just to unmute yourself and interrupt me as we go through. It would be better if you do that than the chat, because then I can just hear you. Just for some context, this paper is the final chapter of my DPhil thesis. So I would really like your feedback on this. Please be as critical as possible so that my assessors aren't that harsh on me. So I'd appreciate feedback early. And yeah, without further delay, let me just share my screen and get this started. Okay, so can I just make sure all of you can see the screen as well? For those on video, just, yeah, great. Okay, so this project is about bringing breakthrough technologies to market, and it particularly looks at the case of renewable energy. And the motivation is, to this audience, it's fairly clear. We have an imperative to reach net zero by 2050. The UK has a target to fully decarbonize its power sector by 2035. And one of the main challenges is to not only, hit this goal, but do so in a very timely manner. So time is of the essence in this particular case. And as we've seen from other issues, such as the global pandemic, there's really an issue where there's lots of risky technologies that are socially beneficial, like vaccines or climate resilient materials. But how do we get investment in them before the crisis? Rather than scrambling on the heels of a crisis, how can we really be prepared in advance? So with the case of clean energy technologies, they're linked to a host of positive externalities. The one we often talk about is the climate externality, but they're also linked to reductions in local air pollution, which creates cleaner air, and also positive gains for biodiversity, because with clean energy, you push out hydrocarbon energy and you reduce the risk of oil spills, gas flares, deforestation, and this also has biodiversity benefits. So while we somewhat price the climate externality in some jurisdictions, and even this price is nowhere near as high as it should be, many times we don't price any of the other benefits. So we don't usually do this biodiversity bit or the clean air bit. And so that's one reason why we expect that the quantity of clean energy in equilibrium would be much lower than what's socially optimum. But that's actually not the only reason. We also have other issues here which are related to credit market imperfections. So you can't write a contract for every type of risk that exists. The costs of writing such a contract are too high, and there's a just fundamental impossibility to writing in every eventuality that may occur. And so that kind of creates the scenario where you cannot simply hedge against all types of risk. And that's particularly important for like clean energy projects or for these large, infrastructure projects, because there's a lot of kind of upfront capital investment, and most of it cannot be recovered if your project fails. A lot of these projects are very site specific. They're adjusted to the topology of the site or whatever, to how far it is from the shore. And so you can't really recover it if the project fails. And some costs are just related to due diligence, contracting, negotiating with local councils. Those are just simply sunk. So what happens is that then there's this kind of rational reluctance to invest immediately. And I call this rational because investors should consider risk. That's a normal kind of element of this. But that rational reluctance leads to suboptimal levels of clean energy in equilibrium because of these other market failures, which we haven't addressed, the unaccounted for positive externalities and these transaction costs and incomplete contracts. So this is kind of why we have the perverse outcomes. And just to, I mean, I went over this, but this table kind of summarizes the various types of risks that are linked to clean energy projects. In this particular paper, I'll be looking at one of them, which is the electricity price volatility. So I'll explain this in a little bit more detail as we go along, but this is just to let you know that there's all sorts of risks related to planning and permitting, construction delays, and so on. So it is, there's a decent amount of risk in this sector. Now, what is my research question given this? So I've explained that we want to bring socially beneficial breakthrough technologies to market. These are associated with risk. And the question is, how do we bring them, how do we diffuse them in a timely manner so that we're not scrambling at the heels of a crisis? The second question is, what is the most efficient way of doing this? I mean, there's a bunch of market failures here. What is the best way to do this in terms of cost effectiveness and efficiency and optimal resource allocation? And third, to just zoom down on my particular context, is to what extent has risk mitigation via feed-in tariffs helped diffuse solar technology in the UK? So that's kind of the aims. In terms of how I'll do this, it will be a mix of theory and 2 empirical strategies. So the theory will show decisions of investment under uncertainty with endogenous fixed costs. And then the empirics would exploit an exogenous reduction in the FIT tariff and do an event study design. I'll also exploit the feed-in tariff eligibility threshold via a bunching estimator. So you'll get more details on this as I go along. But very quickly, I have a very comprehensive database of renewable energy projects from their inception all through the planning process, which is maintained by the UK Department of Business, Energy and Industrial Strategy. And this isn't just a sample, it's the whole population of UK renewable energy projects. So from this, there's 2,500 solar projects. They started from 2010. I have data up to 2021. The average size, the range of sizes is huge, from like small solar home systems to massive solar farms. Just to let you know, the 350 is an outlier. This smoothly continues till about 69 megawatts. This is just an outlier. But the median end mode is around 5 megawatts. The mean's around 9. I get electricity prices from Aurora. There's a bunch.
Sugandha, quick question, if you don't mind. I'm just wondering about whether we should think between risk and uncertainty and how that fits in with your story. So I mean, risk in the sense that we know prices are very volatile and we can quantify that risk, and maybe because of that volatility, that's why things are expensive, versus the uncertainty story, which is a bit more, we just don't really know what's going to happen to prices, and that's why we're unsure about the investment project itself. So I'm sure it's both of those, but I'm just wondering if that's kind of a meaningful distinction here, or not so much.
Yeah. So in this case, most of the risk can be calculated because you have forecasts of electricity wholesale prices, as well as kind of past observations of fluctuations. And I mean, it's increasingly sophisticated where you sort of know how the wholesale electricity price fluctuates with gas availability and so on. So I would put this in the risk department rather than the like fundamental Knightian uncertainty, where I guess for the benefit of the audience, that's like climate change. We just don't know what that distribution looks like. Whereas I think in this case, we sort of know what the distribution, we have some priors on what the distribution looks like. Yeah. Thanks for the question, Tim. And in the interest of time, I won't go into the literature too much, but it's going to speak to several different strands: the economics of renewable energy, the economics of investment under uncertainty. On the empirical side, the application of bunching estimators, which thus far has been mostly in the context of tax and strategic manipulation around tax increases. So I'll extend it to a very different context. Financing clean energy projects, which is a nascent literature, but very much emerging. And then empirical analyses of UK decarbonization policy. By empirical, I mean econometrics and reduced form causal inference. Okay, to set ideas, let me just quickly go over some theory, but it won't be too extensive. So I think one question, when it came to my first question of sort of how do we incentivize optimal levels of investment and an entry into socially beneficial but risky technologies, we can think of a firm problem that's specified as follows. You can either wait before entering, or you can enter today with a feed-in tariff, or you can enter today without anything, without any policy support. And I haven't showed this, but if you solve the value of waiting recursively, then in expectation, this is just kind of sort of like a discounted value of investing where you just consider sort of the mean value of investment. But anyway, let's just consider very quickly what the value of entering with a FIT looks like. The feed-in tariff has an eligibility threshold, so you can only get a feed-in tariff if your project is under 5 megawatts of capacity. So you're kind of limited by the constraint, which is shown here. But the advantage is you get this fixed feed-in tariff, which may or may not be an advantage. It totally depends on what this rate is. But this kind of shows you kind of what your profits look like if you enter today with a FIT. So you have some immediate kind of gain, and then you have some flow of revenue that accrues over time that's discounted. Now, just note that every time you wait, you forego the immediate kind of revenue that you get from entering today. But you might want to wait because certain elements here, this is kind of a cost shock or volatility, might mean that investment costs are really high in the current period, which means that there's some benefit to waiting and seeing how things evolve the next day. The waiting also is important in the sense that if you're not entering with a policy, then you're just subject to the wholesale electricity price, which can fluctuate. Okay, and your profits from this look like the following. I think one thing that's distinctive about this model, which I think is key, is that you can notice that investment costs increase in the volatility of price. In the case of the feed-in tariff, you just get a FIT, you get the FIT tariff, so there's zero volatility. But in this case, you can see that actually, if the project is debt financed, then yeah, this, your cost of capital will increase, and your investors will certainly be thinking about how much volatility of revenues is there. So this kind of shows. And the preference to enter with a FIT today, so let's just for a second assume that you want to enter today, then the preference to enter with a FIT is given by the symbol R, which is the value of the FIT minus the value of entering with no policy. And we can see that it changes in certain variables. So your preference to enter with a FIT increases in the volatility of your wholesale electricity price. It also increases, sorry, there's a missing thing, but it also increases in your FIT tariff rate. So as your FIT tariff rate becomes higher, then you prefer the FIT. So that's intuitive. But what's also interesting is that if the average wholesale electricity price goes up, then you prefer not to enter with a FIT. So this is holding everything else constant. And this is intuitive because your feed-in tariff caps the upside of potentially very high wholesale electricity prices. And this chart just kind of shows how what the difference between the wholesale price and the feed-in tariff, the FIT tariff have been. And certainly between 2010 to 2012, you can see that you would have been better off just without the feed-in tariff because, I mean, in terms of the pure revenue angle here, and that's because the wholesale electricity prices were higher. But just to decompose this a little bit, this model shows that there's two effects of the feed-in tariff. One is the price effect, which is coming in through the rate here. And the other is the volatility reduction, which reduces investment costs through this kind of cost of capital channel. And finally, you can see that there is some constraint on quantity, project size with the FIT. This is just to kind of benchmark ideas. The model, which I solve, shows a couple of results. The feed-in tariff can certainly result in more timely investment in entry, especially in high volatile conditions where there's a lot of fluctuation in the wholesale price of electricity. I also predict that some generators that initially might have planned to be bigger might relocate to the feed-in tariff threshold of 5 megawatts because they want to take advantage of the volatility reduction. Then I finally have this result which shows that we might want to pick a feed-in tariff rather than our conventional production subsidy. So just to show this kind of idea, a production subsidy equal to the externality will not cut out volatility. It will just top up revenues. So the kind of dotted line over here shows how that gets topped up. But a feed-in tariff can give you simply, if it's set to the average wholesale electricity price, it just cuts out all the volatility. And via the investment cost channel, that can kind of reduce your costs. And if you look at this value on like a per year basis, that functions similarly to a production subsidy. But the advantage is that in expectation, it could just be costless if there's, if you're risk neutral, because all the times, this is a case of kind of price bounds, but all the times you're in excess of the rate are compensated for the times that like you give back. So, and in expectation, it can be costless. Another thing to just note over here is that volatility reduction will be done for specifically those generators where you think there's some kind of positive externality or value. So the market rate for electricity will still be visible. It will still be sending signals for every other generator. But for that small segment, let's say of small solar generators where you think they're really bringing some value that the market is not accounting for, then you can give them this kind of volatility reduction instrument. And I want to just draw a little parallel here with the fair trade literature, which says that, small agents, small farmers operating in global commodity markets, like a farmer in Ghana that's selling coffee, the fair trade literature says that there is an argument to actually give them a volatility reduction instrument. And I'm saying my setting is not too dissimilar because a small solar generator also sees these widely fluctuating prices, and there could be some rationale to give them just a fixed rate to cut out that volatility. So I quickly wanted to just draw that parallel.
Sorry, Sugandha, just so I understand the story correctly, it's the idea that an investor is choosing between potentially a more rewarding but riskier path versus this safer, more stable regime under the FIT. And so there may be people that prefer potentially losing out on the upside of the wholesale price, but benefit from the stability from the tariff in terms of not having those higher investment costs. Is that the kind of the main story?
Yes, that's the main story, Tim, but it depends crucially on what the feed-in tariff price is. If the fixed price is much higher than the wholesale electricity price, then the feed-in tariff is effectively acting as a subsidy and a volatility reduction instrument. If the feed-in tariff rate is exactly equal to the average of the wholesale electricity price, then it's purely a volatility reduction instrument. If the feed-in tariff price is lower than the average expected wholesale electricity price, then the feed-in tariff has the volatility reduction benefit, but it has a slight cost because it really, in expectation, you get less revenue. I hope that's clear. So it crucially depends on what the tariff is. And in my sample, I have the feed-in tariff functioning. Sorry, Cameron, do come in. Yeah.
No, finish your point, and then I'll come in afterwards.
Well, no, in my sample, I have the FIT operating as something that's less favorable than the wholesale electricity price as shown here. Then I have it functioning as something more like a subsidy effect on top of the volatility reduction. So I have this variation, time variation, which I exploit in my empirical strategy.
Thanks. I just want to share with everyone the conversation that we've been having offline, because I think you've done a good job of partially answering it just now. So my concern with this proposal, as Sugandha knows, was that it's not costless socially to remove the price volatility, because the prices are sending important signals to the market about either overproduction or underproduction. And whether the frequency of your grid is too high or too low, that is costly, and prices are helping to maintain balance and avoid blackouts, brownouts on either side, with oversupply or undersupply. So the idea that the volatility reduction benefits the firm, but there's kind of magically there's no cost to it, I was a bit resistant of. Now, Sugandha, you've kind of partially answered that by saying, pretty well answered actually, saying, well, to first approximation, it's like small countries in an international trade regime. It doesn't actually affect the overall signal that the market is getting, because these guys are small and there's not very many of them. And I think that's a pretty good answer, actually. The additional point that you could make is that even wind and solar can turn down. They can't necessarily turn up unless they're already down. So if you've got a situation where you need to load shed to maintain the grid stability because you've got oversupply, and you've got a bunch of things on the grid like nukes and this isn't a big issue in the UK grid because so much of it is gas, which is dispatchable. But in general terms, it could be quite valuable for those wind turbines to be able to turn down to stop a blackout because there's too much going on to the grid. And there's no incentive for them to turn down once you've eliminated the volatility. They just are going to produce no matter what. And so there's some, again, I think you can probably dispense with it by saying, okay, well, in theory, yes, Cam's made this point, it's right. But actually, in practice, in a system like the UK system, there's so much dispatchable gas that the grid can balance itself. So we don't really lose all that much by, slightly dampening the price signals here. So I just thought, I need to say that to you at some point anyway. I think you've got a good solution here, but I thought I'd just say it publicly because others might be interested.
Yeah, no, that's really useful. And I'd like others to also weigh into this conversation because I gave this answer with the first approximation, but I think there is more to think about, and the curtailment is an interesting angle. So everyone mull over that. Let me push on. In terms of the institutional context, this audience knows it quite well, but let me recap some key features. The feed-in tariff was introduced in 2010 and removed in 2020. It guaranteed a fixed tariff for each unit of electricity produced. It was a long-term contract over 20 to 25 years. The eligibility threshold was under 5 megawatts of capacity. And I looked at solar because it accounts for 64% of FIT eligible projects. So it was just a great kind of case study. I had good statistical power. The feed-in tariff rate for selling electricity back onto the grid was 39 from 2010 to 2012. And you can see at this point, actually, the wholesale electricity price was higher. So, going back to Tim's point, it's not always the best rate. But then it moved up to around 52. And that was higher than the average spot market rate. So at this point, it was both a subsidy and a volatility reduction instrument. And yeah, this is just speaking to the point that people often say, oh, FITs, they're subsidies, but no, they're not always subsidies. It really depends on what that tariff is relative to the spot market price of electricity. But they are always risk reduction instruments. So that is always true. They are sometimes subsidies. Now, I have two reduced form empirical approaches of estimating the impact of feed-in tariffs. So going back to kind of my motivation, I'm asking if risk reduction can really help diffuse socially important technologies. So I'll be looking at entry and project proposals as an outcome variable. And I will also be looking at project size as an outcome variable to see, has this policy really resulted in a lot of entry? Has it brought in a lot of megawatts of capacity? And the first way I do this is via an event study. So here's a plot of solar project proposals in the UK, so entry rates. This is kind of on a monthly basis. And I can show that you can kind of roughly see from an eyeball, like an eyeballing exercise, that changes in the fit seem to really affect the amount of entry in the solar market. So first of all, I can't prove this point, but like solar projects only start with the announcement of the fit, but you can't statistically necessarily test something like that. Then I see at line A, there was an increase in the fit tariff where it went from being 30 something to like 50. And you can see broadly, okay, there's like a positive trend. And then the very interesting thing here is that in September 2015, there was an announcement by the conservatives that they will significantly dilute the fit. And by significantly dilute, that meant an 89% reduction in the tariff, at which point it's actually a terrible tariff. There's no point, even using this policy. And they had kind of larger plans to kind of dilute and scrap the whole thing. Now, I argue that this is an exogenous event. It is not related to other variables that would affect solar entry otherwise. So if you look at kind of macroeconomic conditions in a window around this event, they're pretty stable. And if you look at what's happening to solar panel prices, they're actually decreasing. So whatever estimate I come up with will probably be a lower bound because solar panel costs are actually moving in a direction which would suggest more entry rather than less entry. Now, what happened? You can see this shows the monthly plot, but if you look at yearly, there was a peak in 2015 of 566 new proposed solar projects. And right after the announcement, there were only 32 solar projects proposed in 2016 and only 16 in 2017. Yangtze, please come in.
Yeah, just a curious question. So do you have any explanations for the fluctuations between 2012 and 2016? Is that like a seasonal trend or something?
It's basically the winter effect. People don't propose these projects in winter, but like in summer, you just have more of this kicking off.
Seems interesting.
Yeah.
And I think we've discussed this, but do we know how much of these projects are primarily for exporting onto the grid versus self-generation?
Yes. So most of my the UK based the data set I use is actually all commercial projects because you can't disclose information on solar PV home systems. So most of this has the intention of they're all commercial projects, so they're all oriented towards selling to the grid. So yeah, that's a really great clarification. There's a whole other story which I hope to talk about with more data because I've sent in a data request to Ofgem, which is on the residential side. But this data set, which is publicly available, talks about the commercial side only. So we are thinking about export to the grid, not consumption by households. So anyway, so this is like really strong suggestive evidence, but we can do something a bit more formal. So first, let me just argue that this really was exogenous because there was some miscalculation in budget, expenditures, which led to the cut in fit rate, and that wasn't related to general macroeconomic conditions. And also, the conservatives had won just like a few months before, and the cuts in public expenditure broadly were also in line with sort of their ideology. And then I had a big long chat with EOS friends to confirm that this is broadly, exogenous. And the more kind of, formal event study design shows that there is this 90% drop in the number of proposed projects in the year that immediately followed the announcement. This is the monthly plot, and you can just see that it's a very persistent effect. In fact, the rate of solar projects never recovers from this announcement, and then the FIT scheme was closed. The other thing that we can see is that the FIT, we have this intuitive sense that it would encourage bunching around 5 megawatts, because if you had planned to be larger, you can just reduce your capacity by a little bit and bunch around 5 megawatts. But in expectation, if you have beliefs that the fit is going to be scrapped, we would expect capacity then to increase. We should not see any more bunching at 5 megawatts. Now, I basically sort of see this, but the error bars are so large because, as you know, the entry becomes so small in the periods following the announcement that I lose a lot of statistical power. So you take this with a grain of salt, but broadly you can see that, yeah, that it gets slightly bigger. Now let's go on to the bunching estimator. First, let me just show you visually what's happening. This is a histogram which has the count of solar projects, the proposals, by the solar capacity. And what we can see is further evidence that firms value risk reduction because there seems to be a lot of bunching around strategic thresholds where risk is lower. So first of all, there is bunching around the 5 megawatt threshold where you get this total reduction of price volatility. And this is a significant bunch. Like, this is huge. I'll preview the results relative to a counterfactual in which there is no feed-in tariff. The mass here is 22 times more. So this would look very different if there was no discontinuity and incentives. But the other thing which I haven't studied yet, but I could do in an extension is this other bunch, where if you're more than 50 megawatts of capacity, you have to go through the protocol of nationally significant infrastructure. And that produces a different type of risk to what I'm considering. This produces kind of regulatory risk, that kind of risk that follows a Poisson process. It's a yes-no type of risk. And the chance of no increases a lot more once you're building things that are this big. So this is something interesting. I don't look at it right now. I focus on this one. And the way to do this is that basically, as I said before, I have my observed distribution, and then what I'm going to do is plot a counterfactual distribution. I'll construct the counterfactual distribution using observations that are outside a window, around this notch, okay? So what this notch will do is it will create a behavioral response whereby some larger projects relocate back here to take advantage of the fit. And so what I want to do is I want to exclude those observations because those are still responding to the change in incentives. So I could just consider some, data points here and some here, and use those to fit a high order polynomial and construct a counterfactual to show what the distribution would look like in the absence of a feed-in tariff. More formally now, I show this here. I do control for some peculiarities such as round number bunching. So you can see it more in some of my other charts, but people just select on round numbers, and that has nothing to do with discontinuities and economic incentives. That's more just a reference frame effect. So when I fit my counterfactual distribution, I just have to control for that. And then basically you have your observed distribution, which is this thing here. And then your counterfactual just omits the window where we expect the behavioral response of the fit to occur. So hopefully this is clear in words. We can look at the maths more, but I've basically explained it in words. And what I see now is that, and just mind you, we're looking at specifically what's happening at 5 megawatts. But basically there's a 22 times increase in the number of projects at 5 megawatts relative to a no-fit world. So this is a very significant effect. And out of this effect, 1/5 of these generators might have actually existed, but they would have been larger. So they would have actually picked maybe 6 megawatts or so on. But because of the fit, there's some amount of lost capacity and they relocate back to a lower threshold. But overwhelmingly, 4/5 of the response are just simply new entrants. They are not the ones who are the marginal bunching generators. They have just entered because of this policy. And so this leads me to say that whatever efficiency loss there might have been from the people who decide to become smaller, that kind of lost capacity, that is more than compensated by the new entrants. And so that's, I think, kind of interesting. And then I think this is something else which maybe I really want to talk to the audience about, but one may also consider the relationship between so there would be kind of a predicted relationship between the amount of solar irradiance and the optimal capacity. And you can kind of predict what that optimal relationship is. And then we have the observed relationships, like what we actually observe. And the interesting thing here is that around 5 megawatts of installed capacity, predicted solar irradiance is higher than observed solar irradiance, suggesting that projects are suboptimally big. And to me, this is a little bit perplexing because if you remember, you can get the fit between 0 to 5 megawatts, okay? So actually, you know, if you see that your site has lower solar irradiance, then you can just, you know, be 3 megawatts or 2 megawatts and still, you know, you can still kind of get the volatility reduction and all the benefits of the fit. But it seems that there might be, my hypothesis is there might be, for all the projects that enter, maybe there's a reference frame effect where they see the 5 megawatt eligibility threshold and just max out and locate there, even though they could still get the fit incentives at a lower rate. And just to say, this is also very strongly suggestive of the extensive margin response, which is confirming that most of the bunching is driven by new entrants. Because if you remember, for people who are planning to build more but relocate smaller, we should see exactly the opposite of what we see here. Because for people building to planning to build more, solar irradiance would have been higher. They would have kind of optimized that way. And if they become smaller, then we should see that our observed solar irradiance should be higher than kind of what's predicted because it's driven by the relocation effect. But instead, it's smaller, which reconfirms that a lot of this bunch is like new entry projects that would have not happened without this policy. But I just find it really fascinating why they wouldn't have been anywhere lower because the fit is just smooth. You could have been smaller. And to be fair, by bunching at the 5 megawatt threshold, if you enter and bunch there, you are still paying more for those extra panels. Tim, did you unmute yourself? Yeah.
Yes, I'm just thinking, so the interpretation is possibly, I guess it could go either way. One positive story is that the fit is allowing areas with less irradiance to make solar be financially feasible. And that's why we see that dip, if I understand correctly. Or I guess it's the converse, which is that maybe these areas shouldn't be having the solar that they are, but it's kind of subsidizing them to come in. So I think it's interesting. That's more of a comment, sorry, than a question.
No, I'm really glad you said that because I hadn't thought about it. Cool, let me mull over that and yeah, remember this point, we should talk about it. Implications. So what is this whole project saying? And by the way, just one more thing before I go into this is that I talked briefly about decomposing the effect of the fit. So we want to know how much of this bunching is driven by the volatility reduction component of the fit versus the price effect of the fit. Now, how I will do this is I can take my reduced form estimates and I can take the theoretical model that I showed you before. And all I need, I have all the, like once I have this bunching estimate, all I need to do is fit data on investment costs, wholesale electricity price, and then I can infer the value of volatility reduction via the of reduced volatility via the cost of capital channel. So that is something that's work in progress, but I just want to say that there's a connection between the theory and the reduced form estimates, because I can use my equations and the structure that they provide to decompose these reduced form estimates. I also do some more stuff where I show this bunching for different time periods, because if you recall, there was a time when the FIT actually just gave a price that wasn't that great relative to the wholesale electricity price. And if you decompose the bunching estimator for different time periods, you can kind of see the variation in bunch as the tariff rate changes. And I do see that there's actually a smaller bunch then. Of course, you need to control for other factors, but this is just some indication of the kind of richness of possibilities with this type of analysis. Now, let me just share my headline results, and then I'll talk about value for money, and then we'll open up the discussion. So I conclude that the FIT unambiguously played a very important role in the birth and diffusion of solar technology in the UK market. I feel confident in making this claim given the results. Would be great if you can challenge me on that or test me. The prospect of FIT removal reduced project entry by 90% in the year that followed the announcement. That's the event study estimate. And because of the discontinuous incentives that the FIT creates, there's a 22 times extra mass around the 5 megawatt threshold. So essentially, without the FIT, we would lose about 533 projects at the 5 megawatt threshold. Remember, the total number of solar projects in the UK is around 2,500. So we'd lose these 500 or so projects. And out of the 500 or so projects, I say, 4/5 of these are new entrants. They wouldn't have located at 5 megawatts in the absence of FIT. They wouldn't have located anywhere. They simply wouldn't be there. The project of FIT removal does lead to a slight increase in project size, but any benefit from this is entirely several times over wiped out by the reduced entry. And then there's another counterfactual that if there was a smooth feed-in tariff policy, say there was no cutoff in eligibility, then that would totally remove the relocation effect, the marginal bunching generators. But the benefit of this has to be outweighed against the cost of extending the FIT's remit. So there is some cost to actually extending this policy. And value for money terms, so this is where we can have a conversation. The UK solar load factor is low, so someone may just say, well, the marginal pound is better spent on wind or something else. But there are benefits because one, which I haven't fully done in this analysis, but solar is very modular. Your house can't have a wind turbine, but it can certainly have a solar panel. So there's some kind of benefit to citizens. And then there's a benefit to this kind of diversity externality because the sun shines during the day, wind blows at night. So, solar does bring this certain benefit in terms of just, balancing the grid and adding more diverse options and not putting your eggs all in one basket. So the overall assessment of value for money, one can do a welfare analysis, maybe I'll have to do one, but it comes down to how you weight like the gains from like generation versus citizens versus grid. And even in the generation bit, this isn't just negative, there could be benefits here. But yeah, it depends on kind of what weights you give to these different use cases. Thank you for listening. I would love to have a discussion now. Thank you. Francois, yeah.
Hi, Sugandha. Nice to see how it's evolved in a couple of months. So I find it a bit difficult to think about this without thinking about productivity and misallocation. So I'm actually puzzled that there is a feed-in tariff for a particular for small installations, given that at least on the US data, as far as I remember, the bigger the plants, the cheaper the electricity out of it. So I'm not sure what the rationale is for subsidizing something that's on paper inefficient. So can you say something about economies of scale and whether you've thought about maybe it's worth removing the subsidies at that level?
Yeah.
The alternative is not necessarily a subsidy or not, but
yeah.
what level to put it?
Yeah, that's a really good question, Francois. I would say that there are slightly different use cases between those like extremely large solar projects, which are when you're 10 to 15 megawatts versus the 0 to 5 range. So the use cases are slightly different. So let me make a couple of points. Firstly, there's kind of a public expenditure question, and you want to limit how much you spend on the FIT scheme. So that creates this kind of cost effectiveness considerations where you just simply want to set some sort of threshold because you care about public expenditure. And if you limit it at something like 5 megawatts, you have a good sense of how much generation that would produce at the load factors. And so you can kind of limit your overall public expenditure. So there's some kind of, we could write some sort of social planner problem where you consider optimal use of public monies and how much like solar capacity should be subsidized. And I think the risk of, overshooting the budget is much higher if you extend it to 69 megawatt projects, which on a really sunny day, they'll blast so much solar and you'll have to kind of give the feed-in tariff to all of that generation. So I think, limiting in that way gives you that kind of reassurance that the maximum you'll pay will be this amount, and maybe that is optimal for the government. The second thing to say is that the use cases do slightly change. As we go to those really big solar projects, they're just completely different beasts. And in fact, in my bunching estimation, I only compare like for like, and I think that limit is at 10 megawatts, because once you start going above that, it's almost like a different technology with different cost considerations, and it doesn't become a like for like comparison. So I think that's why if I extend this analysis and think about that 50 megawatt threshold, I would treat those as very different projects with different cost structures and so on.
Okay.
I don't know if that fully answers, but
yeah, but it would be nice if you have to check data on cost and economies of scale and productivity, just to inform the reader of what's behind. And
no, I completely take that point, and it's a really good one. And I don't have the cost data yet, but I'll look into that.
I mean, it's slightly of a heroic assumption, but perhaps with that cost data, you could imagine what the situation would look like using the model if the FIT threshold was at a higher level. So I mean, you'd have to think through how that would work with the model, and of course be very like back of the envelope, but it could be something to consider. If you have like this good cost data, you could maybe then do some counterfactual where the FIT threshold is 10 or something to see how, because we'd imagine the bunching would be lower just by design, but it would be kind of interesting to see if you could trace that in some form.
That's true. The structure of the model would allow for that. That would address Francois' point. Thanks, Tim. Thank you. Samira.
Hi, great paper. I have, my question is mostly referring to the econometric setup. The first question, which I guess is very straightforward, why did you decide against the regression discontinuity? And if you had no specific reason and why you decided in favor of bunching, apart from, of course, I see the value that it is easy to argue for scientific contribution to say to be using a method in a field where it's not standardly be used, which is a much more, let's say, strategic academic value added point to be made rather than that being driven from the method itself. But regression discontinuity would be a direct competitor for bunching. If you have done it, I would be interested to see how the results differ, because they have ever so slightly differing assumptions. And then the other one that I'm kind of, my concern might be a bit too much, but that kind of came up would be spillover effects between the different agents making a decision. and it should be easy. I couldn't really follow the set of controls you have included, but to kind of, there's multiple approaches from different methodological toolboxes that you could exploit to factor in spillover. So I wondered if you, if that contemplation even crossed your mind, or if you have a clear argument why spillovers are absolutely not warranted a second thought in this context. But great work.
Okay, great. Yeah, thanks for the question, Samira. So on why I didn't do a regression discontinuity design is because there was strategic manipulation around the threshold. So typically in a regression discontinuity design, you assume that observations on either side are equal in all other respects except for the treatment. But in my case, one could argue that everyone who decides to move from 6 megawatts to 5 megawatts is in some way quite different from the ones that are just at 6 megawatts. So I think that's kind of that's kind of a problem here, that one of the main assumptions might just fall through, because I do see that there is strategic manipulation, and insofar as we think that those generators are somehow different because they decide to strategically manipulate, then I can't identify things anymore. The second point on spillovers, I'm not sure if I understand it totally, and good point on like just showing my controls better. So I will definitely do that in the next iteration. But yeah, I guess I'm not totally sure what you mean by spillovers, actually.
So my decision, so my behavior being influenced by someone else's behavior, more so by those people that are more similar to me. So essentially what you could identify most easy in a network, or if you wanted to go machine learning by clustering, or if you wanted to be, if you had geographic information, you could also just say the people that influence me the most, or the other firms that influence the most are the ones most closely located to me.
Yeah, no, that's a really good idea. I do actually have the geolocation of all of these projects, so I could kind of see if there's some sort of effect between sort of neighboring generators. So yeah, I hadn't actually thought about that. So that's really cool. Thank you. Yeah. Thanks, you.
Yeah, so I'm still like interested in the monthly trend. So on the figure you showed, because this reminds me so actually of a similar policy in China. As you mentioned that like in 2016-ish, it's like the Conservative Party, they announced the plan to dilute the feed-in tariff. So I don't know if you know the detail of this announcement. Is the announcement on the same date as when the plan is going to be effective? I'm asking this because this reminds me of the similar thing happening in China. So in China, they also like announced they would decrease the feed-in tariff several times, but usually the announcement is made in December, and which says it's going to be effective in July next year. Yeah. So that's why there's usually a trend that we see people rushing to install the solar panels just before June the next year. So I don't know if you also observe the similar trend. And also, since I think you find some detailed impacts on the feed-in tariff on the size and also new entries. So I think it may be worth to do like more in-depth analysis to see whether the change in feed-in tariff have impact on like more details, how do you say, like detailed projects like different sizes, or when the feed-in tariff is removed, then how's the impact on those non-eligible projects?
Yeah. No, great points. So in terms of this announcement, it said that, so in September 2015, they said that from 2016 onwards, you'd have this 89% reduction in the tariff rate. And so it was something that would come into effect only from 2016 onwards. But unlike the China case, I don't see any like last minute rush to take advantage of any few remaining months. And that's probably because like the announcement was made in September, and there's the seasonality where in winter not much happens anyway. And then it was gonna be in effect by kind of 2016. So there was kind of no rush. So that's kind of an interesting point. And on your second point, Yancy, on exploiting other outcome variables and adding that richness, I think that's a really great idea. I can definitely test the FIT's impact on many other outcome variables. And one of the things I've been thinking about is potentially also looking at solar patenting in the UK as another outcome variable. I'm not sure what I will see exactly, but yeah, it could be interesting. And as you said, the data also has more possibilities on size that I could do. So thanks for the feedback. Shiyu.
Oh, hi, Sugandha. That's a really interesting paper. And I'm not pretty sure if my point will be directly relevant to your main part of study, because I just saw on the last slide that you might also consider the value on grid. So this might be relevant to the Cameron's point, because like if like maybe like there are solar panels that they might, or all the solar projects, they might be preferred to be bunching in like to be built like in bunching in some locations that are beneficial for them. For example, like high radiance, or like some like, yeah, I think you only consider solar panels in this project.
Yeah.
So yeah, they might have like some beneficial weather characteristics, and then this might not. I mean, this kind of case might be harmful to the grid. So actually, maybe you can consider that as well. So
yeah.
But I understand that is not your main part of research, but it's just
No, I think that's a great point. There's one idea, which is to take a more engineering perspective on kind of optimal location and size of solar generator as per fundamental conditions, which is like distance from grid, weather conditions, topography, local characteristics, and compare that to like what we actually see, to kind of see kind of the difference and what changes. So that's an approach I haven't done, but I do have the data to kind of do that, to kind of see that from this engineering perspective, what would the optimal look like and how is that different from what we see? With all these things, it's only as good as the model is. So it depends on what this model predicts. But yeah, I think that's a really interesting exercise.
Yeah, I think that's why it's more like related to the social benefits instead of the purely investors benefits, because like I think your theory is more towards investors benefits. So yeah, that makes sense. So.
Yeah, no, that's great. Maybe one last question if there is, but. All right, all. I mean, thank you so much for coming and for your feedback. This was really helpful, really great points on more outcome variables, counterfactuals, and productivity and allocation, as well as thinking about the differences between risk and uncertainty and so on. So I have a lot of notes written down, and thank you so much for your engagement.
Thanks so much.